Good afternoon, ladies and gentlemen. Welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it is a source of both great interest and great pleasure for me to be able to host Richard Berner and Simon Johnson today. Global financial stability is one of those slippery terms that we all talk about incessantly, particularly since 2008. We talk about it quite a bit within this building, but doing something tangible about it, it's like the weather that our friends fought through to get here today. You can complain about it, but what do you actually do? And in my opinion, the Office of Financial Research, under Richard Berner's founding leadership, has made a real contribution to actually doing something, to helping us identify where the rain is, how heavy it is, what we should be wearing, and what are the patterns out there. And you need that before you can plant anything, whether it's real investment, whether it's people's savings. And it's in that context we're delighted to have Dick and Simon with us, who are going to take us through what we know and don't know to some degree about the sources of risk around the world, and what we know about how these issues, these risks get transmitted to the U.S. economy, and the spillover effects from the risks here, all in the context of practically what does the OFR do to give policymakers and the American public the knowledge they need. Speaking second will be our colleague Simon Johnson, who is, of course, Ronald A. Kurtz Professor of Entrepreneurship at MIT's Sloan School of Management, but as I hope he proudly, I know, often refers, he is a non-resident senior fellow here at the Peterson Institute. Simon's leadership on financial supervision and regulation issues dealing with banking and especially too big to fail, but a whole host of issues has been quite evident. He has, since July 2014, been a member of the Financial Research Advisory Group of the OFR, and he chairs the new recently formed Global Vulnerabilities Working Group. I'm not going to go through Simon's whole CV, but I think we can all agree that his independence of thought and his global breadth make him very well suited to contribute in that role. So thank you. But first, let me introduce Richard Berner, Director of the Office of Financial Research. I had the privilege to get to know Dick through the years, as so many people did, in his private sector role, where he was co-head of global economics at Morgan Stanley and previously was chief economist at Mellon Bank, at Salomon Brothers, the Morgan Guarantee Trust Company. Like many of the best people, he started his career on the research staff of the Federal Reserve Board. He's got an academic bent, having been an adjunct professor of economics at Carnegie Mellon and George Washington University. And he and I both were on the panel of advisors of the Congressional Budget Office for many years, and I got to see his presentations and hear his macro insights there. But again, I think Richard is one of the people who stepped up in recent years since the financial crisis and made a real contribution, along with Nellie Lang, who recently stepped down at the Federal Reserve, in making the U.S. and the world better prepared for what might happen next and helping us try to prevent or ameliorate future financial crises. Prior to his confirmation as the original OFR director in January 2013, he served as counselor to the Secretary of Treasury. Please join me in welcoming Richard Berner.
Well, Adam, thanks so much for that kind introduction, and thank you for inviting me to be here to share the podium with Simon and with you. And what Adam and Simon asked me to do to start was basically to level set a little bit. Some of this may appear a little basic to some of you, and I'm going to use the obligatory slides to do this. But I thought I'd start by really level setting some of the things that we want to talk about today, and when we get into the meat of the discussion, these may serve us in good stead as a framework. So I wanted to talk first about the lessons that we learned from the crisis, some of the basic ones. Second, how we define financial stability, because I think that's pretty important in thinking about what we do about it, as Adam was implying. Second, or third rather, what are the institutions we now have in the United States that are charged with promoting it? And fourth, and very importantly, what data do we need and what analytics do we need that we didn't have in the crisis that to assess, to monitor the vulnerabilities in the financial system so that we can base our decisions on those things. And last, to talk a little bit about some of the risks. So as we think about these issues, I think it's particularly, I think, appropriate to remember that prior to the crisis, we had oversight of the financial system that was primarily oriented towards institutions and markets. And in the United States, we had different organizations aimed at each. Those things are very important to assure safety and soundness, market integrity, and the proper functioning of markets and investor protection. But clearly, the crisis brought to the fore the need to focus on risks that went across the whole financial system. It's pretty clear to me, maybe not to some others, that we really don't have any ability to predict or prevent financial crises. So in that sense, Adam, it is a little bit like the weather. We can't stop the rain from coming, but we need to know what to do about it in advance. And what we need to know, what we need to do about it in advance is to try to make our financial system as resilient as it can be, and prepare for crises when they arise, because I think that it's safe to say that we're going to have more of them. How frequently they arrive and what they look like, that's unclear. But by making the financial system more resilient, we can be ready. So really, when we talk about financial stability, it is about resilience. And it occurs, in my view, when the financial system can still function even under stress. And in various publications that we put out, we identify 6 basic functions. You might want to add to that list if you want to. I skipped over, in thinking about this, one slide, which is very important. This one relates to data, because another lesson from the crisis is clearly that we did not have all the data that we needed in order to monitor, in order to identify risks in the financial system. And that's obviously very important. Let me just go back a little bit here, because I also skipped over quickly this slide. Analytically, we didn't understand the extent of leverage and maturity transformation in the financial system, how activity could migrate from one part of the financial system to another, presumably to more opaque and less resilient parts of the financial system. And we didn't understand completely the potential for disruptions in the system to spread across the system as a whole, and to interfere with its functioning. So on to data, and this is really very important for us. When we think about the data that we need, you probably are all aware that we have a lot of data on the financial system, primarily from banking, but also we have a variety of data that relate to financial activity. Unfortunately, those data were too limited in scope, or they may not have existed in order to identify some of the things that were going on in the financial system. I would argue that the data were also not of sufficiently high quality, so they weren't consistent. We couldn't aggregate them. We couldn't look at them in a coherent way and make comparisons across markets or institutions. And because, in part, of our regulatory framework, they weren't accessible to everybody at the same time. So back to oversight. I think that we can prepare for crises, and resilience is really what we're talking about. When we think about threats to financial stability, they really arise from vulnerabilities in the system that represent failures for any of these functions, either individually or perhaps together. So very importantly, I think resilience has two aspects to it. One is, does the system have sufficient shock-absorbing capacity to absorb shocks as they inevitably arise? And second, are incentives aligned to limit excessive risk-taking in the financial system? And I think we pay a lot of attention to the first, but maybe not sufficient attention to the second. I think both of these things are really important because clearly you need the shock absorbers to buffer the hits, but you also want to harness market forces using what I call guardrails or the incentives that affect behavior in order to increase perhaps the cost of risk-taking behavior that might threaten the financial system and create some vulnerabilities in the financial system. And we can talk about some examples of that. What about the institutions that we have in the United States that are charged with looking over the financial system? Well, we didn't have one, obviously, before the crisis, and so Congress created the Financial Stability Oversight Council, which consists of all the regulators in the United States and some other folks, including the Office of Financial Research, which was created as well under Dodd-Frank. The council has three responsibilities. One is to identify threats to financial stability. A second is to respond to emerging threats by taking steps to mitigate those threats. And third is to promote market discipline. And market discipline means using those incentives, particularly aimed at reducing or even eliminating too big to fail. The OFR was created to serve the needs of the council, to provide the data and analysis that is needed in order to look across the financial system, and so the council can do its job. Our job is to improve the quality, the scope, and accessibility of financial data. Our job is to fill the gaps in analysis and to complement the council's work by assessing and monitoring threats. Our job also is to do some basic research and look at the building blocks that help us understand the functioning of the financial system better, and to evaluate policies, not to make them, but to evaluate policies and promote best practices in financial risk management, because there is an alignment between the things that we do as policymakers and the things that financial firms do in managing their own risks. So when we think about data, I mentioned that the data that we had were really not adequate to our task. And one key area that I just wanted to mention, I'll focus on a couple, is in the area of what are called securities financing transactions, or short-term wholesale funding is part of that. And that's obviously critical for the functioning of the financial system. And we understood that broadly because firms engaged in short-term wholesale funding to fund their inventories of securities or for other purposes. So broker-dealers were engaged in them and others. And the repurchase agreement market and other short-term wholesale funding markets are extremely important for financial system functioning. We didn't have then a holistic view of how those markets worked. We understood that during the crisis, they didn't work too well. Liquidity dried up, and we needed to take a holistic view in order to understand better where the problems arose and how the markets were functioning and how they might be changing. So in order to do that, we need to map out the landscape, not just in these transactions, but in others. And mapping out the landscape, you can see that we look at both sides of transactions. And intrinsically, these transactions involve an exchange of cash for securities. And that can happen in both directions. So you have securities dealers in the middle, for example. You have a variety of sources of funds. For example, securities lenders, real money investors like insurance companies or others. And on the other side, you have borrowers like hedge funds and broker-dealers. You notice that they're on both sides of the transaction, or they can be on both sides of a transaction. They can be both borrowers and lenders. And that's what's made the analysis a little bit complicated. But by mapping out the transactions that do occur, we can have a better hope of understanding where the data gaps are and how to fill them. we can also have a better understanding of how we want to analyze the functioning of these markets. Likewise, when it comes to money funds, by now you're all familiar with the problems that we had with money funds. Money funds are money-like liabilities, and most people prior to the crisis believed that pretty much money funds were redeemable at par, and that worked out pretty well until stress hit, and they were no longer redeemable at par when one of them broke the buck, and we saw a substantial exodus from money funds. So in response, we, the regulatory community, particularly the SEC, filled the gaps in data that we needed to analyze what the issues were with money funds by collecting data on so-called form NMPF. And the SEC has been collecting those data since 2011. And you see a representation of those data here in what we call our money market fund monitor. If you look on our website, you can see an interactive version of this monitor. It gives you in great detail information about who's exposed to who, how people are borrowing, how people are lending in these markets that are important sources of funding for the financial markets. So filling these gaps in data is extremely important. Let me turn now to some of the risks. One of the ways that we want to think about risks and financial stability, looking across the financial system, is to separate them into buckets of risk. And we think about 5 buckets of risk: macroeconomic, market, which includes interest rates and volatility and other asset prices. It includes credit risks, funding and liquidity risks, and contagion risks. Contagion, of course, is the risk that might occur when a shock hits one part of the financial system and gets transmitted to other parts of it. And we have created this financial stability monitor, which uses those 5 buckets of risk to assess, using this kind of heat map on a preliminary basis, how we might want to frame our overall risk assessment. And it's a red, yellow, green kind of traffic light kind of system. And you can see that as of the first quarter of 2016, and we'll be updating and publishing this in a couple weeks or so, that the risks are not severe. You can see that they're sort of in the middle of the road for most of these things. Macro risks declined a little bit over the past year as growth has started to improve. But one of the things that inevitably an overall assessment, an overall monitor or heat map like this really can tend to hide is the details, the granular details. And as we think about macro risks in particular, we think about the risks in the global economy and how they might affect the U.S. economy. So in our risk assessment, we think about some of the primary macro risks as those that might arise overseas. If European banks experience more difficulty, could that spill over into the U.S. financial system? That's one set of risks that we want to look at. Second, if for whatever reason we see a greater slowdown in China or other large regional blocs in the global economy, how would that affect the U.S. economy and the U.S. financial system? So shocks from abroad are a key factor in our thinking. And that's one of the reasons that we want to have a conversation in a minute or two about some of those risks. Those aren't reflected here in detail, but if you look at our website, you can drill down into these risks and see some of the details in this monitor. I'm going to leave it there so that at this point, that's just a stage setter, and we can then have a conversation in detail about some of these issues with Simon and Adam.
Much as frequent attendees at these lunches, in fact, anybody in Washington knows, to have an official who says, I really want to have time for discussion and actually means it by cutting their remarks, their prepared remarks short, is a big deal. And joking aside, I think it reflects well, not just on Dick, but on the OFR's commitment to being a publicly engaged and open institution. And I know from talking to some of the people here at lunch, there are a lot of people who already are using their data. But maybe Simon, who has been engaged but is independent of the OFR, can offer us a bit more of his take on where things stand.
Before he starts, let me just point out, if I could, Adam, you mentioned that Simon is a member of our Financial Research Advisory Committee. The committee is comprised of about 30 members drawn from different walks of life. We have a research committee, and Adam serves a subcommittee. Adam serves on that.
Simon serves. Adam does.
Simon serves on that subcommittee. Maybe Adam will at some point in the future. Simon serves on that subcommittee, and you can see the list of people on the website. But we wanted to make create a committee that was very broad in scope and diverse. People often say in diversity there's strength, and nowhere can you find that better than in our subcommittee. And given, we have outspoken members like Simon and others, we've got very lively discussions. They're all transparent. They're all in the public domain. We webcast them. And so this kind of discussion is exactly what we're looking for.
Okay, so now that we have all patted each other on the back, and I may even get a future appointment, Simon, please.
Okay, thanks very much, Adam and Dick, and thanks, Adam, for hosting this event, and thanks, Dick, for coming up today. Maybe I could just say three things briefly, and then we'll discuss more freely, and obviously with all the participants in the room as well. So in the first point, I do a little bit more back padding, if it's okay. I do want to be on the record very clearly as saying I think OFR has done a terrific job in terms of addressing the issues that Dick laid out. This was an important problem that was agreed across partisan lines after 2008, and OFR was given the fairly difficult task of addressing it. I like the weather analogy a lot, Adam. I would focus on hurricanes and think about hurricanes. Because if a hurricane, and we've got a lot better on forecasting hurricanes, including the conditions that create them and the precise path, and it matters a lot whether or not you call it right in terms of do you evacuate people, but it also matters, sort of Dick's point, whether we prepare properly, what's the resilience of our buildings and our communities to severe weather events, including hurricanes. So I think OFR has really done a terrific job within its mandate of addressing this. Now, the second point is of course, about the mandate, and this is not a criticism of OFR or actually a criticism of Dodd-Frank, because Dodd-Frank is an American law. It's the jurisdiction of that law and the jurisdiction of any agency created by that law is only the United States. But what if we had hurricane forecasting only within a 12-mile distance of the American coast? I think it would be a lot less useful, right? So financial crises in the modern world, I think, are inherently global. I can't think of, I'm looking at Chang-Yong Ri, and he and I have worked on these issues for a long time. Chang-Yong is now a senior official at the IMF. I'm trying to remember last time we had a major crisis that wasn't global in some way, Chang-Yong. I think we'd have to go back before the 1980s, perhaps, to think about that. So they're intensely global. They spread in unexpected ways. And I think part of the challenge that OFR has, and part of what Dick is, I think, one reason he's here and to talk with all of us, is how do we think about the world outside the United States? What kind of data do we have? What kind of data is available to OFR or anyone privately or in any official capacity, including the IMF? Do we share this data well? Do we share it in real time? What are more specifically, and this is the task that the working group that I'm involved in at OFR is trying to grapple with right now, and I'm absolutely open to ideas and suggestions on this, but what's the set of problems in the world that matter for the United States, that's OFR's mandate, about which we don't have enough data, either in real time or with any kind of lag that would make it useful. And I've got a couple of big problems on my mind, and I'm just speaking for myself here, to be totally clear. European banks. What's the exact status of European banks? What happens if one major European bank is in trouble? What's the potential domino or spillover effect within Europe or to the US in some way? And frankly, Chinese banks. I think I have the same issues there. Now, I do agree with Dick that, we can focus, we drill down into loss absorbing capacity or shock absorbers. And I like to think in terms of capital in the financial system. And I like very much Morris Goldstein's book, which is forthcoming from the Institute, that I think all of you should read as soon as it becomes available in any kind of underground copy. As soon as it's officially published. It's this fantastic book that really drills down into this.
Now, I have to say, for the record, Morris had been invited multiple times to give sneak previews of his book, and he has always declined. So you do have to get your tickets now for the rollout in the spring.
The anticipation is building, Morris. Let's be clear about that. Okay. So I think that you can't know everything. And so one question is, what does OFR, what would they benefit from knowing? How could they know this? Is it through cooperation with other authorities? Is it through private market, publicly published information? Is it through data entrepreneurs who make this available? But I think the issue of capital and everything that goes into capital solvency determinations in key markets, I think that's where I would focus, and that's where I think our working group might or might not end up. But I'm absolutely here to listen to everybody in this room and everybody listening on the webcast to ideas in that direction.
Before we open it up to everybody, couple points. First, I do have to make the plug that we will be publishing Morris's book, but also Bill Klein's forthcoming book on bank capital as well. We have two very strong independent assessments of the way forward. There are some differences between them, but both of them, I think, are going to be extremely impactful contributions to the public debate. So look for your invitation in the early spring back to the Peterson, or actually late winter, back to the Peterson Institute. But let me push you on the data thing. So one of the issues that is always sort of amazing to us nerds is data's a public good, right? And on bank capital, at least, unlike some of the scurrilous accusations that were made unfounded against the Bureau of Labor Statistics, I don't think anybody's been accusing any of the US or European or even Chinese regulatory agencies, supervisory agencies of bad faith. So can you give us just a bit more sense of where are the black holes? Where are the dark, or I shouldn't say black holes, the dark parts.
Dark holes, yeah.
Dark parts is better, that we can't see into. And why is it in the FSB process that we haven't gotten there? Obviously I don't expect the Chinese government to tell us everything about a regional bank in Chengdu, but for the SIFIs, for all these things that were agreed on at the international level, why hasn't that turned into data yet?
Let me first respond a little bit to Simon's comment and answer. It's all three. Obviously firms are global, markets are global. We are national, and that requires that we collaborate with our global counterparts. And we do extensively in a lot of ways, which I can describe. But one of the ways that we do that is to engage with them in agreements, a memoranda of understanding, so that we can exchange data in a way that keeps the data secure and safe, and yet in a way that we can, in the public sector, we can access those data for our needs to evaluate threats that might originate or be amplified or transmitted across national borders. And there's a mutual, obviously, benefit both for them, our counterparts, and for us in order to do that. Now, we're not the only ones who do that. The members of the Financial Stability Oversight Council also clearly do that, other U.S. regulators. I think this speaks a little bit to Adam's question, why is it taking so long? Why are there still gaps in data when, A, this is a public good, and when, B, the need for having high-quality data that are accessible to people who need them in order to make these risk assessments is so transparent. And I think the reason is that a lot of the data are not shared publicly, and they, if they fell into the wrong hands, whether they have commercial value or other kinds of important value and would have an impact if they fell into the wrong hands, the natural instinct is not to share them. And that's totally understandable. And so what we've tried to do is work towards, what we call best practices and data sharing in order to make sure that we can do that in a way that is secure, that is safe, so that a supervisor in the UK or down the street at the Federal Reserve can go to sleep at night knowing that their data are just as secure as if they kept them themselves, if they shared them. And a good example of sharing is, I think you're all familiar with a very important tool that was developed at the beginning of the crisis. It's not a completely new tool, but stress testing is one of the real tent poles, if you will, of financial reform that's enabled us to assess the resilience of financial institutions and increasingly of the system as a whole, although there's a lot of work to do in that regard. The Federal Reserve has a process that's known as the Comprehensive Capital and Review process, and they use stress tests of large, complex financial institutions in order to prescribe to them what their capital policy, what their dividend policy ought to be. And this is a very important part of our regulatory infrastructure. As you can imagine, the data that are collected for that purpose are highly confidential, have a lot of commercial value, and so understandably the supervisory team at the Fed doesn't want to share those with a lot of people. But after 3 years of legal work and other work, we in the Fed have agreed that the Fed would share those data with us appropriately, and we are therefore better able to carry out our mandate to evaluate stress tests, to look at the way that the stress tests are being done, not necessarily to say that they're bad or not, but really to say, look, here's what we learned from this evaluation, here's how we can make improvements. And having the data is important in being able to do that. And as a consequence, we've been able to have discussions with the Fed about where improvements might be made, and they've given us feedback on our work, and that kind of collaboration is very important. Another example goes cross-border. We have a MOU with the Bank of England and all of its constituent parts in the ecosystem of the Bank of England. And we share not just pure data, but information that is pre-decisional so that we can benefit from each other's insights and we understand where risks are going on around the world. But I think it takes a long time to do this work. It takes a lot of patience and perseverance. I know I can speak to that from 5.5 years of doing this. I'd love that it goes more quickly and more smoothly. But I think it's worth putting in the effort to get to where we need to go. And I would say that we've made a lot of progress in filling those gaps, but there still are big holes. I showed you securities financing transactions. Shocking that half the repo market in the United States, we had no comprehensive data for that. So we're filling that gap in the Office of Financial Research. The flash rally that occurred in the Treasury market on October 15th of 2014, more than 2 years ago. That data threw into sharp relief the shocking fact that we didn't have very good data on secondary market activity in the U.S. Treasury market, the deepest, broadest, and most liquid market in the world and the benchmark for pricing other securities around the globe. And so the 5 regulators involved, among them the Board of Governors, the New York Fed, and so on, put out a request for information, and those data are now going to be collected by FINRA in sync with their other data collection processes. So we are filling those gaps, and maybe we're slow to recognize where the gaps are. But I think there's another aspect to it that's important, and that is working closely with market participants and the industry in order to share ideas about where the gaps are and how better to fill them and how we can do it faster. I think that's another aspect that will help solve this problem.
Let me push you both for a second. So you seem to be saying it's largely a matter of we'll achieve a certain amount of trust and we'll get a certain technical fix and it will happen. The data sharing, the filling of the gaps. But
that's in an ideal world.
In an ideal world, and we're not going to worry about that. But in the present situation, so there are a lot of people who are quite concerned about the Chinese financial system. Our friends in the Asia department at the fund and at MCM at the fund are doing their bit. Others are doing theirs. What kind of information in today's world are you able to give the public and policymakers? And Simon, of course, is a little freer to talk. But given that we face this now in real time, for all the benefits of your patience and persistence, what can we know now about China's financial fragility?
I think much less than we'd like to know, simply because it's very difficult to get our hands on the data, and I think Qingnan can testify to that. We all have snippets and anecdotes, and every once in a while we see through the curtain and we see glimmers of what the problem might look like, and it's pretty amazing. The growth in debt relative to GDP in China has been pretty rapid, especially in the last 2 years. And so, not knowing, however, the details makes it very difficult to say, this is a huge problem or this is something that's manageable. And I think that it's getting those details that's important. So it's not just the Bank of England or the ECB or other, developed country institutions we need to work with, and we as a regulatory community need to work with, but we need to work with Chinese authorities to persuade them that it's in their interest and ours to have more information about that so that we can both address these problems if shocks arise that threaten the system.
Thank you. Simon?
Well, this is the question that our working group is trying to pursue, Adam, precisely. And I think that first you need to assess what the priorities. So you say China, I say China. We can think of other countries that have trouble around the world. So we have to think about, are they big enough? Do they have enough financial flows or other interactions, right? Europe would also, I think, be on both our agendas. And then if we have that sense of priorities, I have various ideas about how we might address it. And to tip my hand slightly, I'm hoping that the IMF will be able to become more involved in facilitating these exchanges and integrating this information. There are plenty of responsible officials in these various countries who you and I know personally who care all about financial stability and know that shocks go both ways, right? So they don't want to be the cause of the disturbance or on the receiving end in some unanticipated fashion. So I think we can work on that, and I'm hoping that our group can be constructive to OFR, particularly because we're not official, or we're official only in this advisory capacity. So we can have slightly broader conversations, perhaps. I think the longer-term issue that interests me a great deal is the structure of data in the financial sector is clearly changing very rapidly. And this is because of the advent of what we somewhat call loosely blockchain technologies. So a more decentralized way of managing data within large financial firms, that's a huge issue. Across markets, so within all those market participants in the securities financing transaction, for example, the data is very fragmented, very dispersed. It will not be like that in 5 years. It'll be much more integrated and managed in a decentralized fashion. That's my prediction, but there's hundreds of millions of dollars going into that technology. So I'm fairly confident making that prediction. And we have a big project at MIT, as you know, which spends a lot of time with industry participants and thinking about that. Now, I am hoping that if those blockchains are structured appropriately, there will be better sharing with supervisors. So the supervisor, instead of I get data, I tell the supervisor with some lag, and that's an annoying process, of course, to fill out those forms, the supervisor should be one node on the blockchain, and they should be involved in verifying transactions and securing the data, just like other participants. So that changes how supervisors get information. Of course, there is this key issue that you and Dick are flagging, which is, okay, the supervisors have got it. What good is that for the rest of us? Well, here's, I think, a role for OFR, which is developing tools that preserve confidentiality to an appropriate degree, but allow them either to have an overall financial stability look at what's going on, or, ideally, in my view, a view that they can publish and make available to people. Now, that one's probably more tricky, but for OFR and the people working with OFR to have that real-time, in-depth, sensible analytical view across supervisory data within a core set of countries, I think that's completely attainable. It doesn't compromise national sovereignty. I think it's purely in the interest of financial stability and better understanding where the hurricanes are or about to hit.
Let me just pick up on another aspect of that point, more broadly than just DLT or blockchain technology. We have to think that financial innovation is a constant. It's going to evolve. It has evolved. It's not just technology. It's economic incentives that create the incentive to move activity from one part of the system to another. So the venues in which activity takes place are always changing and are migrating. The nature of that activity may change. People in the financial community are, always looking for creative ways to meet client needs or to do other things, whether it's to manage risk or to hide risk or, something in between. So I think we have to recognize that we're going to be trying to follow where the puck is going, to use a hockey analogy, not where it is. And the portrayal that we have here is in our money fund monitor, for example, may help us do that by understanding, where the funds are moving and how they're moving. Because changes in regulation clearly affect changes in business models. They clearly will affect how people invest and how people manage risk. And that's going to change the sources and the way we collect the data that are available to us.
Right. One final question before I open up, because we have a lot of great people in the audience. And let me put this to Simon and then Dick. But, we're looking now at Italian banks. We're looking at Europe again. And a number of my colleagues and myself included don't think this is the end of the world by any means. But there is this interesting aspect that part of the problem seems to be that some of the European governments and supervisors have a different vision for how to provide for financial stability than some of the American supervisors now do. They don't like stress tests. They don't think you need to raise a lot of capital. They like having, like in the German system, stilles reserve and hidden reserves. As we move from the sort of technical good process into where there's genuine differences over policy, over what constitutes financial stability, how do we cope with that? How should people on the outside, should we be sort of throwing up our hands in a sense and saying they don't do good practices on supervision in Europe, stay away? How should we think about that kind of issue? Because Simon, you've written on this, on the genuine differences between European and American approaches.
Absolutely. My only idea on this at this point, Adam, is that we have to measure carefully what happened. So people have different ideas about the building codes that withstand hurricanes. Okay, these are genuine differences. Everybody's acting in good faith. Well, let's see what happens when hurricanes hit, and let's measure it carefully. And my colleague Andrew Lowe at MIT had an idea at the time of the crisis that it hasn't been picked up, and I think it's a little unfortunate, of having an NTSB, National Transportation Safety Board, for finance. So in other words, when either you have an accident or a near accident, NTSB investigates incidents when there was no loss of life. When the U.S. Airways plane came down on the Hudson, nobody died. In fact, the injuries, fortunately, there were a few of them were quite minor. That was a big NTSB report. I've read that report. Extremely insightful, including where you might want to sit on certain planes. But I think we need that on finance, and we need it across countries, and we need it in depth. And like the Flash Rally, well, there is a very good report on that. I think we need to be encouraging authorities in different countries, and to the extent that one can do it from the outside, but of course is limited, that's back to the data, trying to push them and say, look, this is what we understand has happened in Portugal or Italy or Spain or Germany. Challenge us, show us the data that we're wrong, that we're not interpreting this right. I hope that they see that in a positive light, and I hope that leads us in this direction. But frankly, I am a bit frustrated at this stage.
The only thing I'd add to that is to say that, I think we in the United States have an obligation and opportunity to show global leadership in that regard, and to show that what best practices look like, to demonstrate that there's not only one way to do something, but there may be a set of things that we can do. I listened to Mervyn King yesterday at breakfast, who said, in effect, Basel is dead. At least that's the way I understood him to speak, and that global coordination was something that we really shouldn't pursue. And I think the kernel of truth in what Mervyn was saying is, look, we need to get our own house in order. And I think demonstrating best practices in that regard, and actually doing the things that balance the need to have a strong and resilient financial system with one that, after all, does continue to provide its basic services and can attract capital from investors. Finding that balance, I think, is really important. And it's pretty clear that in the European banks, in many cases, that it's very difficult for them to attract capital from private investors, and they need to do the things that will help them do that. So I think that's where we can show leadership.
Great. Let me now open it up. So this meeting is totally on the record. We have a traveling mic up front with Jessica. We have a standing mic at back. Please wait to be recognized. You can stand up at the standing mic and get yourself in the queue. Please identify yourself when you speak. And the more what you say sounds like a question, the more time you get. So, at the back mic.
Barry Wood, RTHK in Hong Kong. You touched on the European banks, but in light of a European or an Italian referendum on Sunday and the concern about Deutsche Bank, how would you assess the general vulnerability of European banks?
That's a question for me. Well, so I'm obviously only giving you my personal opinion, not speaking for any other organizational person on the stage. I'm very worried. We have a simulation that we run at MIT every fall with an executive program. And in the last 3 years, we've done the European crisis, and we did April 2017 as a scenario this year. And a number of, so this is a war game type tabletop with some very smart and well-informed people participating. And, you know, what comes out of this, I think, will be some further action by the European Central Bank because they don't have any other good options. I don't think that leads the real economy or the financial system actually in a good direction. So I think it's in the extremely worrisome part of the whatever color that is in the
red
color.
part.
The red. Okay, it's red in my color coding.
Let me just add 2 seconds. Jessica, you want to get a microphone over there? I spoke at a conference in Frankfurt 2 weeks ago that was specifically to try to bring non-German perspectives to Germany on these issues. I think the issue has got to be when we're looking, and Bill Klein did a publication for us on this recently. I think the issue in Italy and Germany and Deutsche Bank and some of the medium-sized Italian banks in particular is not an information issue. I think when we talk about China, again, this is just me speaking for myself. When we talk about China, these banks, there's an information issue. When we were talking about things in the midst of the crisis, there was an information issue. There were information issues in the U.S. in some of the clearly dark pools, so to speak, that were out there. So it's not, but what we're looking at when we look at Deutsche, and we're looking in the Italian mid-sized banking system are instances of moral hazard and failure of will. So in Italy, it's about they allowed them to sell bank bonds to small savers. And so you have a conflict between the European stated desire to bail in private investors and the political strength necessary to recapitalize those banks. And that's just a pure political hard call. It's not about information. We all know what's there. Similarly, I think for Deutsche, there is definitely a technical assessment to be made, and Bill's done one, and various official sector people have done one. There's a technical assessment to be made, but the real issue is Germany, the German government just doesn't want to force a recapitalization or further dilution there. And that's not an information issue. So again, I'm not suggesting my colleagues on stage we're saying everything's an information issue. It's just to remember that not everything is about information. Sometimes it's we all know too well. We've seen this movie, part 6, 7, 8, and 9 before, and the question is, how does this particular sequel get resolved? Do you want to give a mic to Morris over there and then the front table?
I'm Morris Goldstein from Peterson. In thinking about where the next hurricane might come, I would suggest we look closer to home in the following sense. If you look back at what is the best single explanation for a systemic banking crisis, empirically, I would say the best explanation is credit booms paired with overvalued property prices. I think that's what works best. So then you ask yourself, well, what's going to happen in the U.S.? Judging from the new administration's pronouncements, we're going to have a big fiscal stimulus. Growth will probably pick up, at least in the short term. So loan demand will be up. If the Fed leans against that fiscal push, interest rates will be up. The term premium will be up. Banks will be earning more. Maybe they'll use a little bit of that to build capital, but I would predict they would use much more of it to pay dividends and to do share buybacks. And we have the man, I think, cited to be Treasury Secretary in today's paper saying, well, we need financial deregulation, and particularly we need to do that for banks and others because we just need to pump up loans, and if we have too much capital, that's going to lower loans. So we seem to be having a resurgence of light touch financial regulation coming, and so I would be interested. I know this is all speculative. No one knows exactly what will happen, but I wonder whether someone on the panel would address that homegrown source of potential financial vulnerability.
And just to buy Dick 1 second more time, maybe one way of addressing it, not that you need my guidance, is to say, were the things Morris says to happen without your having to put a probability on them, how would they show up in your heat map? How would you track them?
Well, let me do it in a slightly different way from what Adam suggested, and that is, Morris, when we think about some of the risks that are out there, we've already seen a very substantial increase in leverage in non-financial business and a very substantial rise in commercial property prices, two of the ingredients that you talked about. Those aren't clear and present dangers in our view, but both things are worth watching very closely because typically they are associated with excesses and financial imbalances that give rise to vulnerabilities in the financial system. And I'm not alone. We're not alone in that sense. If you read the minutes of the FOMC or you read financial stability reports other than ours, you can see that those things also feature prominently in those. If you read the FSR that came out from the UK, from the Bank of England, they're concerned about the property price boom that's going on there at the moment. So this is not just a U.S. homegrown phenomenon. It's in part a consequence of the backdrop that we've had for years now of lower for longer interest rates and volatility, a rise in asset prices, a reaching for yield, and a natural, those are some of the consequences. They are consequences of other things too, but it's pretty clear that those are things that we need to watch carefully. So I would say that those are things that we have been focused on for a year or more. Even if growth does improve, there are still questions about credit quality because underwriting has not been as good as it might have been. The growth of covenant-light loans, the growth in loans outside the supervisory perimeter in non-bank financial institutions that are not as closely watched. A variety of factors contribute to that growth, and those are things that we need to watch pretty carefully. The difficulty may be in sort of deciding when they turn from a situation which you continue to watch carefully into something else. That's why we have monitors like the one I depicted. That's why we continue to do analysis. That's why we continue to try to assess what is the probability of default and what's the loss, given default, and how far down the tail do we chase those risks.
Simon, do you want to add anything?
I agree that Morris has laid out a plausible and worrying potential scenario. I think this is a stress test for our post-2008 institutions. There was a bipartisan consensus that we needed better data, and really, financial crises are not in the interests of almost anyone, right? So are we going to continue to have what we have, which is an ability to look at the data and have Dick and his colleagues tell the truth? And if you look at their heat map, which is showing on the small screen, not the big screen, good call on interest rate risk, Dick, which I know not everyone, people were skeptical when you put that in 2015, But that was an excellent call, and it's going to be fascinating to see how those colors change in the next report, which of course I don't have any insight into how you're coming out. But I think that our ability to show what's in the data and to be consistent despite whatever political changes, I think that's really important. And we built some structure after 2008 on a non-political. I have no idea on this Financial Research Advisory Committee which party various people support. No idea, never comes up. It's just a good, technical, sensible discussion. So I think these are non-political issues, and I hope they remain non-political.
Great. Over here at the front.
Good afternoon. My name is Luigi. I'm in the awkward position of representing an Italian bank here in Washington, D.C.
Not all Italian banks are the same.
Thank you. That was the point I was about to make. Well, the bank I represent is actually very big. Our balance sheet is in the tune of more than 700 billion euros. So, we have 35% of the corporate market in Italy, 25% of the retail. So this is the perspective I'm looking at things. You have mentioned Italian banks. It's a bit appalling, if not disappointing, when I participate in this kind of venues, to hear about Italian banks as if they were all the same. And Adam just pointed out that this is not the case.
I kept saying a set of medium-sized banks.
Right,
That's
right.
one particular set.
The banks that you have mentioned, those who have sold subordinated bonds to their retail investors, those who are overloaded with non-performing loans, those like Monte dei Paschi, well, we all know that, we were having this discussion before lunch. You run your model and you ended up that Monte dei Paschi needs capital injection. Well, that's not very big news. Everybody knows that. And they're precisely what they are doing now. They are swapping debt into equity. And Generali, the largest debt holder of Monte dei Paschi debt, has already said that they would swap everything into the equity. So what I'm aiming at is that the problem is extremely well known. The dimension of the problem is extremely well known. The banks which are in trouble have been very carefully ring-fenced. We all know what needs to be done, and it's being done. So my question is, do you honestly and seriously believe that banks that have less than 2% of the market share in Italy, do you honestly believe that they can jeopardize the financial stability of a G10 country like Italy and the financial stability of Europe? Do you honestly believe that as an academic? I would be surprised if your answer were yes.
Simon, to be fair to our guest, you did indicate reasonable concern over Italian banks.
Yes, look, I'm not backing down at all from what I said. I didn't come here to bash Italy. I'm not here to try and destabilize anybody's market situation. I prefer that we talk about it in private subsequently, precisely why I'm concerned, and we can have a good discussion about that. But I can assure you that the spirit of this discussion, just like I think the spirit of the work that we all do in this room, is about having serious discussions on important issues. And I'm not in the business of exaggerating risks or trying to bash anyone. I think if we can't have such discussions in public in this kind of forum in Washington, D.C., that's another level of problem. So, I stand by exactly what I said.
Okay. So at the back, Mike, and then these two tables.
Bill Klein here at the Institute. I would be very interested in your view of the concern of people like Scott at Harvard that Dodd-Frank left us with an hobbled lender of last resort. In particular, the fact that Article 13.3 can only be applied if there's a class of entities, and there's been some further definition that could be a class of 5 entities rather than one by one as we pursued in the crisis. And in particular, the fact that loans from depository institutions within large bank holding companies to the investment bank subsidiaries of those holding companies cannot exceed 10% of the capital of the depository parent or the depository affiliate. Cannot exceed 10% of the capital in the sub. In short, have we tied our hands for an aggressive budget intervention of the large players because of this set of changes in Dodd-Frank.
For what it's worth, a year ago in Foreign Affairs, I said, yes, it was a terrible thing. But hey, that's just me. What do you guys think?
Why don't I start, Bill, by issuing a disclaimer? Since lender of last resort is really part of monetary policy, part of the Fed, and I make it a practice not to talk about monetary policy. But I will say that we probably can do a better job, and I think central banks around the world are and can do a better job of tying their lender of last resort facilities to financial stability issues. And there's more work to be done on that score. But I think...
what does that mean?
What it means is to think about the governance and the rules surrounding lender of last resort facilities, to take steps to remove the stigma that might be associated with borrowing at the discount window, to do what Mervyn King suggested yesterday, which the Fed is doing and the Bank of England are doing, to pre-position collateral with the central bank so that they can have a look at the collateral and evaluate it, and then to lend against that collateral when they know what they're talking about, rather than making it up as they're going along. So I think there are a lot of steps that can be taken in that regard that are well known. And I think that those are really important steps when you think about a lot of the people who need access to lending facilities. They have those needs because they have runnable liabilities, like securities financing transactions. And so the question becomes, what kind of lending facilities should we make available either on a temporary or permanent basis? More work needs to be done on that, but I think those are some of the issues.
Thanks. Simon?
No, Bill, I don't agree with what you said, but you and I disagree on a monthly basis about all of these issues. That doesn't surprise you. I think that the lender of last resort powers do still exist and could be used under many circumstances, as Dick just mentioned. I think the broader issue, though, is that we've allowed the financial system to become very concentrated. We've allowed risk to become very concentrated. And in 2008, the authorities were forced into providing forms of assistance to some particular private firms that were not available to other private firms or entities or households. And I think the fundamental unfairness of that, the way that reinforces this distorted form of competition or oligopoly power in the financial markets is a big problem. And I'm very worried, actually, we're going to head in another direction. Obviously, this is a time when we don't know exactly what kind of new legislation is going to come forward, but we can see the proposals coming from the people who have the majority in the House of Representatives. And I think those are going to further complicate the task of managing financial stability, including issues that you care about, including lender of last resort, but obviously much broader.
Sorry, again, one more sentence. When you say complicate, what are the proposals and what will they do that you're worried about in particular?
So there are proposals to limit the independence of the Federal Reserve, to make it more political. I think we have a lot of evidence that says that's a bad idea for central banks from a monetary policy point of view and from a financial stability point of view. So that will be front and center, Adam. There are also very serious proposals on the table to remove the orderly liquidation authority, which is, as Bill and most of you know, rests with the FDIC, but also based on decisions made by the Federal Reserve and by Treasury in order to exercise that. And that ordinary liquidation authority is both a power to act and to stabilize the financial system through direct interventions, including in individual firms. It also comes with the requirement that you prepare a living will that explains how your firm could be liquidated, both through bankruptcy and under the OLA. And I think that the proposal that's really moving forward would remove that requirement substantially from all firms, including some of the ones that are systemically important, with the result that when and if they fail, you won't be able to put them through bankruptcy. You will be forced into one of these awful situations where it's either bail out something in a very unpleasant, unsavory, politically unpopular way, or let it collapse and have massive global consequences. I don't think we want to be in that position, and I think we have retreated from that position and improved. It's not perfect, I agree, but I think Dodd-Frank significantly improved that situation, backed us away from that, I fear that we'll move back towards those kinds of really unpleasant decisions.
Thank you for spelling it out. So over there.
Thank you.
And Steve.
Yeah, I know. I can do this part of my job.
Neil Rowland, MLEX News. For Dr. Berner, 2 questions, please. First, the Choice Act in Congress would eliminate OFR. What, in your view, would be gained? What would be lost by doing so? Second, with the change in administration, do you have any plans to resign?
Oh, good. Real reporter questions.
I'll answer both questions. On the first, I think we've talked a lot today about the benefits of having created the Financial Stability Oversight Council and the OFR. And I would refer you on the former to a speech that my colleague Antonia Weiss gave yesterday at the University of Pennsylvania talking about the benefits for the council. What I've tried to do today is to talk about the benefits to members of the council, to the public at large, from the work that we do, namely to fill gaps in financial data and analysis to improve the quality and the scope and the accessibility of financial data. So if somebody else were to do that, then maybe we wouldn't lose all that functionality. But we're charged with that mission, and that's the law, and that's what we plan to continue to do. On the second question, my term ends on January 1st of 2019, and that's when that's the latest date at which I'll leave.
If I can just add, I think for various reasons, my colleagues on stage are going to put together FSOC and OFR. I, speaking just personally for myself, am willing to go much more to the mat for OFR than FSOC, because FSOC as an interagency process is inherently a mess, and it reflects the fragmented nature of our regulatory supervisory system, which should be fixed at a more fundamental level. OFR, or something like OFR, and I think they've done it basically right, will be of use to the American public, to whoever is the regulator, to whatever happens and whoever's making the decisions in future. You're going to want an OFR or something like it. So to me, even though politically and perhaps legislatively they're the same thing, I actually think we can, if people decide to reopen the governance of the FSOC, that's one thing, but nobody should be questioning the utility of the OFR, because whoever is in charge is going to need it. That's just my opinion. Yeah. But be brief, we have one more person waiting.
Listening carefully to Dr. Berner's response, he said January 1st, 2019 was the latest date that he could serve. Do you have any thoughts about leaving before then?
Oh, come on.
No, I don't.
That's a direct answer. Thank you.
Sigh. At this table, please.
Steve Kamen from the Federal Reserve. So I noticed, Dick, when you have your heat map up, that the impact of the external sector on U.S. financial stability gets a light green. And so I was just wondering, how do you basically look at financial stability issues abroad, and then how do you translate those risks into a potential impact on U.S. financial stability? And in that mix you're looking at, what do you view as the key, risky areas abroad, that entered into that calculation?
Right. We raised the screen, so we can't put that back up, but if you look on our website, you can see that. But what Steve is talking about is the first of the 5 buckets of risk. The macro bucket has recently turned more green than yellow, and so that suggests that there's less risk there. And as I said earlier, the macro bucket contains both domestic and global kinds of risks. So while the global risks have continued to increase, they've been somewhat offset by what's going on domestically. That's the first point. The second point is that, as you're well aware, global shocks and global transmission channels can affect the U.S. financial system not just through the macro channel, but through any of the other 4 channels, through credit risk, through funding and liquidity risk, through contagion, and through market risk. And so some of those are not so benign. If you dig into the details of some of these things, which you can do by going to the website and drilling down, had we more time, I'd show you that on the screen. You would see that dichotomy that I talked about between what's going on abroad and what's going on in the United States. The third point is this heat map is a tool, one of several, but not the only one to use to try to assess where risks are. And it's like a screening mechanism. It's the first thing that we might look at, but it's not the only thing that we might look at. Because we know that when we look at these data, which are primarily, because of the need for high frequency, they're primarily market prices or quantities, and they don't necessarily capture all of the dynamics of what's going on around the world or in the United States. It's only one such tool. In order to really think deeply about where those risks might lie, we use this as a compass or a guidepost to start us off in the right direction. It might be the wrong direction, quite frankly. Simon pointed out that the interest rate risk there is painted red. And for a year or so, people said, really? Looks like we're in a lower for longer environment forever. The point about interest rate risk was not so much whether interest rates would rise a lot. The point was that given the reach for yield behavior, the duration, convexity, and other kinds of risks that people had taken on meant that even a moderate change in interest rates could expose them to vulnerabilities. That's really the point here. And I think that applies broadly across the board. So this is not a forward-looking tool yet. Consider it to be the first iteration. Further development is needed to make it a better tool, and those are the kinds of things we're working on.
Great. Sorry.
Sorry, you asked about where we see the risks. They're actually not too disparate from what Simon and Adam have been talking about. While I think that the U.S. financial system is more resilient, certainly than 5 years ago, and that shocks from Europe are likely to be those we can withstand, I don't think we can be complacent about those either. Similarly, shocks that may originate in other parts of the world obviously depends on the severity of the shock, the nature of the transmission channels, and the ultimate impact on U.S. institutions. And the last thing is that, sometimes what we find is that just looking at these things piecemeal is not as helpful about thinking about them holistically. So if we have a shock that originates outside banks, for example, we might actually find that it affects banks indirectly if we look hard enough. And that's an important channel as well.
Simon?
Yeah, just made me think, Steve, and this is sort of relevant to the issue of, what does OFR do and what does the Fed do, sort of that the market can't do. If we only look at market prices as predictors of anything, we're going to miss quite a lot. As I recall, the credit default swap spread of Citibank was quite low in 2005 and 2006. So I think using the market prices as they do is important, but they do a lot more than that, and so do you. And I think that's incredibly valuable and important. And the private sector left its own devices will not be able or want to do anything like what you guys do in the official sector.
At the back, Mike, and this will be our last question.
I'm Dave Michaels with the Wall Street Journal. I suppose I have the obvious journalist question to ask you about the news of the day, which is the nomination of Steve Mnuchin to be Treasury Secretary. And it's interesting, like Mr. Trump, he's an outsider to Washington, but is an insider to banking and finance. And I'm kind of wondering, do you expect, I would love it if all three of you could answer, but do you expect him to be a brake on sort of the urge to completely dismantle Dodd-Frank, or to be simpatico with sort of the policy preferences that are contained in the Choice Act that seem to be, at least for now, the blueprint for deregulation in the next Congress?
Thanks for your question, but I'll answer it in the following way. I'll say that, as Treasury Secretary, Mr. Mnuchin will also be chairperson of the Financial Stability Oversight Council, and in that sense, he'll be my boss, and I look forward to working with him.
Could I?
Very good. Yes, of course.
So I think the fair answer is we'll see, and this is a fair set of questions to ask Mr. Mnuchin as he heads through the confirmation process. The point that I'm surprised no one has picked up on yet, perhaps the Journal is ahead of me again on this, but but take a look at it, is that Mr. Mnuchin is I believe, on the board of CIT Group. And CIT Group is among the set of 20 or so financial institutions that, according to the pending House legislation, would no longer be regarded automatically as systemically important. And whether or not they are regulated, supervised more closely would be at the discretion of the FSOC, or if there is no, which of course the Secretary of the Treasury chairs, or if there is no FSOC, not sure what would happen, perhaps it would go straight to the Secretary of the Treasury. So there's an interesting set of questions there for Mr. Mnuchin about how he views systemic risk, how he views CIT Group in the context of systemic risk, and so on and so forth.
Great. Well, thank you all very much for joining us today, and thank you especially to Simon and Dick Berner for really taking us through the entrails of the financial system.
Thanks for having me.